A member of the World Bank Group, the IFC targets the private sector in particular. Its approach to the extractive sector includes funding oil, gas and mining projects in developing countries. Jan Wehebrink is charged with managing that portfolio. Jan, welcome to Raw Talks.
Thank you very much.
What is the benefit of having IFC on board in these projects?
One obvious benefit is financing. So the dollars that the investees or the borrowers can get from us, but that's not our mission. Our mission is to contribute to the World Bank goals of reducing poverty. In that context, the other benefits that we add in addition to financing is clearly development impact for the countries within which we invest. We provide knowledge, information, but also governance and control support to our clients, the borrowers, who may be international companies operating in developing countries. So they get from us money, they get from us guidance on environmental and social principles, contribution of community and social investment, advice, prioritization, so a whole package of services that go far beyond financing and pure compliance issues.
And is that where the performance standards come in?
That's correct. To narrow it down more to the natural resources sector, clearly this is a sector that has an impact on the environment, that interacts with people, with societies. So it's very important that our investees, our projects follow the IFC performance standards, our environmental and social performance standards, as well as, of course, the national standards. So it's a given that any mine or any oil and gas investment needs to follow the national and potentially larger regional environmental standards, if we take that as an example, but then IFC has a set of its own performance standards, which the company will then need to meet also. And it's worth adding that we help projects meet those. It's not always the case that a client of ours is there on day one, so we will work together to make sure they get there in an efficient manner.
And to be very clear, your client, and when you're talking about that, it's the companies and not the government.
Correct. Our clients are the companies or the projects. Often it is a company, sometimes it's a project financing, but very importantly, our shareholders are the governments.
And who are the shareholders?
So 184, I think, by last count, countries of the world are shareholders. They are represented on our board. So at the end of the day, our fiduciary responsibility both for the development impact and the financial return is towards the countries. And that includes every country in which we invest. So if we're investing in a gold mine in Mali, Mali is one of the shareholders and is represented through the board of directors at the end of the day. But yes, our clients are the projects, the companies, the investments.
Let's look in more detail when you're making these investment decisions. How does the IFC manage the trade-off between poverty alleviation on the one hand and financial returns on the other hand?
It's a good question, and we often get asked that. Both, I think, go hand in hand or hand in glove. Because we're a private sector investor, we invest in businesses in the private sector. For them to be sustainable in the long run, they need to make a financial return. If they were relying purely on donor funding, and donor funding may work in certain circumstances, but generally the profit motive or the desire to make a financial return we believe creates efficiencies in the business. So how we reconcile the two is that by making the financial return, the company is creating jobs, if we take that as an example, or in the mining and oil and gas space, generating royalties and paying taxes for the government. The government is getting the money. Which it can then apply for its budget. And by being sustainable and being able to stand on its own 2 feet in an international financing context.
So you only invest in what you think will be profitable projects?
That's correct. Sometimes they end up not being profitable, but going in we have to meet 2 objectives. It has to be a financially sustainable, profitable project, 2 market rates, competitive rates, we can come back to that, and it needs to have a development impact, a positive development impact.
The IFC can participate in projects with both finance and or equity. What's the split between the 2 sources?
It depends on the sector. So within our sector, we're about 30-70 split, so 30% equity, 70% debt. Historically, the institution has come from a project finance, largely debt funding place, but over the last 10 years we've moved quite significantly into the equity space, so we're doing more and more transactions.
Why is that?
There's a number of reasons. The one reason is that a lot of balance sheets of companies or a lot of the risk profiles of companies are not suited for a debt repayment profile. There may be higher risk, maybe a very worthwhile project in a fragile or conflict country of Africa that simply hasn't got the structures in place yet that's going to enable it to attract traditional debt financing. But by putting in equity risk capital, we can fund that project and we can allow it to advance. Clearly, again, putting the private sector finance and development together, we would expect to see a financial return. We would expect the value of our investment to grow.
So how big is the return if you compare it to a company's return?
Our return is reasonably in line with other private equity funds that you see out there. And it comes back to the earlier question that you asked, no donor funding. It has to be competitive funding. So I think we can keep our own with other private equity type investors. This is on the equity side. On the debt side, clearly we have similar returns to financial institutions on the loan book. So no, I think we're quite competitive, and we've had quite a few investments and portfolios where we've done a lot better than the private sector, because we're getting into countries that others are not investing in yet. They're riskier. We put a much riskier capital into play. We work closely and get very engaged with the companies to help them grow. So we have pretty good results.
And as a lender then, do companies borrow at favorable rates relative to the open market?
No, they don't. Again, that's the very important aspect for future clients. Every client asks us, or not every client, but often clients come and ask us, oh, can we get cheap debt funding from you? And the answer is simple, no. These are market competitive rates. If there is a market like China, Brazil, South Africa, where there is already a banking market in place, then we will generally align to what the rates would be of financing for investments or for debt in those countries. Where we differentiate ourselves in those countries, for example, is we might be able to provide a longer loan for more years, a longer tenor. Otherwise, the private banks can do it, the commercial banks can do it, they don't need us. So we can provide longer tenors, and then we will go off the market pricing, and we will increase the margin potentially if we're going for a longer period, a longer risk.
But there's no risk in crowding out the commercial banks?
What makes IFC so unique is the additional the tenors, the financing structures that we can provide. We have a lot more flexibility around potentially contributing equity as well as debt. We can go for much longer time horizons. We're not a short-term investor. So those are the kind of factors that generally mean we do not crowd out the market. In fact, the goal is that we get crowded out. So if we're in a very poorly developed country or a fragile conflict state again, there may not be much of a debt capital market, and we're the first people to come in and provide loans. The aim, the ideal world would be that a few years down the track, companies have established themselves, they can actually attract money from European banks or American banks, and we're being crowded out.
Governments, they often try to acquire equity on large projects. We saw it in Ortolgo in Mongolia and Simandu in Guinea. What's the IFC's position in this regard?
So we don't have any objection to government participation in projects. The one factor is, again, our private sector focus. It needs to be, the government participation is below 50%, and the company is structured and governed in a commercial way. So yes, the government is a shareholder, but generally the company is being operated in an arm's length commercial kind of way. The other comment I would make, particularly in the natural resource space, is governments have to really think hard about how they want to be involved. They're already getting revenues through the royalties and through the taxes. If they become a shareholder, there's clearly there may be two goals. One goal is to make further return, but that is then increasing the exposure to the natural resources, to the commodity markets. They have to decide whether they can fund the big capital expenditure requirements up front, whether they can fund through downturns. So this is provide additional equity contributions if there's a commodity downturn. They have to decide whether the carry arrangements that may be provided by their partners are a good deal for them or not. So these are all issues that we will look at and that they will need to decide. But in principle, government participants are welcome. And for us, the other aspect in dealing with the government, clearly when we do our due diligence and we investigate a project, we want to make sure that it's a fair and transparent deal for the government as well as the investors.
Now, when you look at your portfolio over time, how do you measure success?
We measure success in two ways. On the financial side, it's relatively straightforward. It's financial return, or the return on our loan book, or financial return meaning cash multiples on equity investments or internal rates of return. And on the loan book, it's the return effectively on the loans. That's relatively straightforward. On the development side, we measure our success through a number of factors. It depends by industry. But to take the example in natural resources, one important measure of success is the royalties and the taxes generated for the government budget. In 2016 alone, we generated about $2.5 billion worth of taxes, royalties, and so on for our investee countries. Other measures that we look at are jobs created. We estimate some 60,000 new jobs or existing jobs were kept through our investments in 2016. We also measure our success in terms of social community investment projects that the companies undertake. Some $40 million of community social investments were made in 2016, again, off the back of our projects. And then finally, a significant impact is also the goods and services that local companies contribute to the industries that we invest in. And there we estimate some $10 billion of additional goods and services that were provided in 2016 off the back of the projects that we financed.
If the project does not deliver economic impact or development impact, is that a reason for you to pull out of the project? It's
not normally a reason to pull out of a project, in the sense that we generally look at the reasons why the project is not succeeding. It is very rare that there is a complete failure to deliver the results. When there are issues, which there are in the natural resource sector, whether they're environmental, social, developmental, then we are long-term investors. We work together with the company and the other stakeholders, the governments, communities, depending on what the situation is, to try to resolve the issue and to try to improve the development impact. We do not run at the first sign of a problem. We try to stick with the project and with the goals and to deliver. Looking back to the last few decades, in your view, does the IFC involvement really offer investors protection against sovereign risk? It's a spectrum from yes, quite a lot, to not a huge amount. It depends on a mix of how important the sector is to the government, how big the project is in relation to the government. But our positive contributions have ranged from ensuring that foreign currency convertibility is possible. So we provide a loan in US dollars. Sometimes when a country gets into economic difficulty, the central bank may restrict the outflow of US dollars to repay debt. There have been some instances where that has happened. Our borrowers, under a certain protection that we provide, have been able to be repaid. That's important for the investors. To be willing to invest in a country in the first place. We have been influential in changing some of the laws relating to providing security over assets for loans, which effectively opens up the country to being able to attract international financing. Any examples there? In some African countries where there have been large multi-hundred-million-dollar project financings, the lending syndicates, commercial banks, did run into trouble because they couldn't get the right kind of pledges or security, and that's where we then sat down with the government and negotiated specific structures to enable that to happen. And there have been some instances, I won't name the specific examples to protect the innocent and the guilty, but there have been instances of arbitrary changes to tax rules, and not windfall tax rules, which one might see in the natural resources space, but really arbitrary changes, effectively trying to, at the last minute, increase the budget coffers in the country, to the detriment of the project, to the point, in fact, in some projects where they would have run out of cash. And then we, together with other multilateral institutions, have stepped in, spoken directly to the minister in question, even the Prime Minister on occasion, and asked them to pull that back. And to be more transparent about it, to reconsider what they're doing. So there have been instances. Most of the time we don't need to do that. I think the general presence, the understanding of any nation that they have a World Bank financing program that goes far beyond IFC provides the protection, but when necessary we'll step in and get involved. I want to move us into today's environment. As commodity prices abated, has your investment activity decreased or increased? Our investment activity has decreased somewhat in the downturn of the commodity cycle, not for strategic reasons. We're not pro or counter-cyclical in that sense, but it's a case of if oil prices drop below $40 a barrel, then a lot of investments are shelved or put on pause. If gold is at $1,000 or below, then a lot of the miners are not going to develop or progress with mine development. The projects are not feasible. So for that reason, simply the markets, the available projects or companies to finance have reduced. So yes, there's been a period where our investments have abated. I see that coming back. And during those downturn times, it enables us to spend a bit more time effectively nurturing those partners that are left that we have invested in.
And why do you not attempt to invest anti-cyclically? Wouldn't that be the logic?
Clearly, from a commercial perspective, yes. But we're a development bank. I think the uniqueness of IFC, so we want to make a financial return. I don't have to have the highest financial return in the world, but I need to make a positive financial return. So within the commodity space, it's more a case of the opportunities of the projects that are being developed. Even in a downturn, there are companies that can make it, and even in a very high price environment, there are circumstances where they require our support. Where one could argue that we are counter or anti-cyclical is in the countries we invest in. We invest in countries that others don't because they are difficult and they are risky. That really is our expertise. With
more commercial banks adopting the equator principles, is the IFC involvement still necessary to ensure high standards?
The answer is yes. The equator principles are very valuable. In fact, they were developed off the back of IFC ideas and incorporating IFC's performance standards, and they continue to be very valuable. IFC clearly requires the equator principle, other banks do, and they can fund projects with the equator principles. But IFC, as I stated in a different context, provides quite a lot more than just the compliance with performance standards. We monitor the performance against our performance standards, which equal the equator principles, but then we work with the companies to go significantly beyond those, whether it's with social engagement, with environmental issues, and I think our monitoring and our oversight of those principles and those standards is probably the most rigorous in the market. So going forward, I think there will continue to be significant demand and requirement for IFC's performance standards and oversight of projects.
And on that note, I would like to thank you for your time.
Thank you very much. It was a pleasure being here.
And to keep up with the new debate on extractives and development, join us at whattalks.org.